On behalf of MK Global Financial Services and the Investors Fraternity, I thank Mr. Amitav Mukherjee for agreeing to come on the call and discuss the 4Q and FY19 results and outlook of NMDC with all the participants. Sir, I also thank you for giving us the opportunity to host this call. We will have the opening remarks from Mr. Mukherjee and on the results and the outlook, followed by the Q&A session. So, without much ado, I hand over the floor to you, sir.
Right. Good afternoon, everybody. It's a pleasure to talk to all of you. This year's results have been fairly satisfactory for us, considering the headwinds that we had in the beginning 2 quarters of the year. We have posted a profit increase of around 500 crores, that's on a 12-month basis. Our profits have increased by 5%, and on a Q4 versus a Q3 basis, it has almost remained constant. Our EBITDA has increased by 16% on a 12-month basis from around 6,472 crores INR to around 7,518 crores. Our EBITDA margins have grown healthy to about, right now it is around 62% on a year-on-year basis, on a 12-month basis, up from the earlier 56%. Profit before tax, we have increased by around 1,000 rupees INR. So that's a 17% increase over 6,179 last year. We have logged around 7,198 this year INR. Profit after tax has grown by a healthy 22%, up from 3,806 for the last 12 months to this financial year of 4,642. Our performance of Q4 as compared to Q3 has almost been similar. So that has been the last 2 quarters, Q3 and Q4, have been rather good for us. The performance, both in terms of physical and financial parameters, have been fairly satisfactory. Of course, as you know, that the first half of the year, we had a lot of headwinds in terms of huge monsoon, which for which our main producing area in Belladilla, we could not produce around 2 million ton in the month of June and July. There were huge increase in imports in the first half of last financial year. So that again took a hit. We did not have any export contracts in the first half. And in the third quarter, of course, our Donimalai mine closed because of a dispute with the state government. Now, despite all these 4 headwinds, the fact that we could not only sustain but actually increase our financial performance is a matter of satisfaction for us. The performance parameters for the Q3 and Q4 have also been very satisfactory in terms of production and sales. Productions, if you see from Q4 to Q3, we have increased by 11%. From the earlier 9.5 million ton to now 10.5 million ton. Although it is slightly lesser than the Q4 of last year, but that is essentially because that we did not have Donimalai. If we see like to like, we did grow a lot if we exclude Donimalai. So even the physical performance in Q4 has been fairly satisfactory, but on a year-on-year basis, on 12-month basis, we have done very well if we exclude Donimalai. For the first time, we could touch the 7 million ton in Kumaraswamy iron ore mine, which is in Karnataka. The 7 million ton is the Supreme Court mandated ceiling there, and for the first time, that is the highest production since inception. So, if we discount the Donimalai closure, our operations in all the units have been very commendable. So, I would now take questions if there are any.
Thank you very much. Ladies and gentlemen, we will now begin the question-answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Before we take the first question, I would like to remind each participant, please limit your question to 2 per participant. You may come back in the question queue if you have a follow-up. We take the first question from Amit Dixit from Edelweiss. Please go ahead.
Congratulations for a good set of numbers and thanks for taking my question, sir. I have two questions. The first one is with respect to the production or sales guidance you will give for FY20. Specifically, if you can break it in mine-wise and the sales that we can expect from exports. That is the first question.
Yeah, the guidance for FY20, excluding Donimalai, we will do around 32 million ton. Now, Donimalai has a capacity of 6 million tons. So, if we get it within a week or so, we will be able to do another 5 million ton. So, we should be doing anything between around 37 with Donimalai, 37, and 32 or 32 plus without Donimalai. Just 1 second, please. The mine-wise production and mine-wise target. Kirandul Bacheli. Second is our export is capped at around 3 million ton. Now, this is with the IGA that we have. The intergovernmental agreement we execute with NMDC and the Japanese steel mills. So, we export only to Japan and to Korea. And the cap for that is 3 million ton. So, that is what we will do this year also. And if you, just to point out that this export is at a concessional export duty of 10%, whereas the export duty in India for a general export of Fe content of 60 plus is 30%. But since these are intergovernment agreements and these have been there from the 1960s and 70s, so the export duty for our consignment for this 3 million ton is only 10%. So we will do 3 million ton of exports, and the overall, excluding Donimalai, would be around 32. Now, this entire export comes from our Bailadila sector, from Kirandul, and mainly from Bacheli.
Okay, great, sir. The second question is with respect to pellet plant. So, we found that pellet plant still made losses in this year. So, despite pellet prices remaining quite high, so can you throw light on the operational aspects of pellet plant, whether it has stabilized or not, what is the capacity utilization, what kind of volumes you expect next year, and are you planning to export pellets as well?
Two things. First is, we are operating at around, in pellet plant today at around 10-15% capacity. It breaks even at around 65% if we take the pellet prices at around 7,200. On a cash cost basis, it breaks even at around 25%. That. Now, the problem is that one of the technologies that was adopted, that of the pellet filter, that has failed. This was a new technology introduced by Andrich. It's again a very famous company. It had a big name. But the pressure filter that they had designed for this pellet plant, it was put in 2 places in India. It has failed at both the places. So now we need to replace this pressure filter. We are in the process of replacing this pressure filter. That is the only hiccup. There's absolutely, rest of the plant is working absolutely fine. There's absolutely no problem with either the grinding system or the pellet making system. It is just that the pressure filter has failed. It was a new technology that was introduced with us, but that failed. Now we need to replace that. So this replacement will take around anything between 3 to 6 months, because the slots that are there in the pellet plant, if we replace with the standard pressure filters that are available in the market, we can run the plant in 50%. So we know we'll have to put in additional pressure filters and do some connecting piping work, and I think it will take anything between 3 to 6 months for us to replace these pressure filters and put in another new pressure filter of 50% capacity, so that the entire pellet plant otherwise works perfectly. The other part of the pellet plant we have tested, we are producing this, absolutely there's no problem except for the pressure filter.
Any volume guidance you would like to give?
I think this year we'll do around 25 to 30% of our capacity. So that will be anything between 4 lakh tons. 3 lakh, because we are contemplating, we really don't know whether that will be successful or not. We are trying to source concentrates from the local market if they are available, and to run the plant for some time, till such time when we can simultaneously proceed to replace the pressure filters. But the solution to this is actually the replacement of pressure filters. The sooner we can do it, the better it is.
Great, sir. Thanks for elaborating, sir. I have a couple of more questions, but I'll come back in the queue. Thank you.
Sure.
Thank you. Next question is from the line of Nityan Barmawat from Aurum Capital. Please go ahead.
Yeah, thank you for the opportunity. My first question is you mentioned about if Donamalai happens in 1 week. So just wanted to know what is the likely date of next hearing of the case, and what are we expecting? Are we expecting the judgment on that day or any further hearing in that case?
Now, so far as Donamalai is concerned, all the arguments have concluded on both sides in mid-February, somewhere around February, not mid-February, around end of February, 23rd or 24th. Since then, the judgment has been reserved. Now, we are expecting it any time. It's been 2-3 months, but we cannot speculate when the honorable justices would be giving out this order. We would like to believe that we have a very strong case. Any litigant would like to believe. But we have been advised by the highest of the judicial brains and the highest of the judicial officers that we have a very strong case. We are hoping that the judgment would now be communicated sooner than later. Let's hope it's only the judgment has to be delivered. No further hearing ought to be made.
Got it, sir. So any date which has been mentioned?
No. The justices have not mentioned any date. That is as per the convenience of the honorable justices. When they are ready with the order, they will obviously communicate the orders. We cannot speculate when that will be done. But let us hope it will be sooner than later.
Got it. My second question is, what is the situation of the steel plant now? How much more investment we require, and when we are going to, likely to start the production in this? It's already delayed now. So, what is the more investment that we require in the steel plant, and when it's likely to start the production?
Now, so far as when we are likely to start the production, we hope that we will be able to commission this plant in the H2 of this year, and our activities are going on in that direction fairly satisfactorily. The pre-commissioning activity we should start in H2, at the beginning of the H2, and by the mid of H2, I hope, we are expecting that the plant will be commissioned. So that is the guidance as of now. So far as expenditure is concerned, against an original estimate of around 15,500 crore, we have already spent around 15,315 crores. 15,300 crores, 15,400 crores approximately.
Yes.
Now the latest revised estimates are being worked out by our consultant Macon. And the first cuts that we have received is not yet confirmed. On a like-to-like basis, it is likely to go up to around 18,500 crores. On a like-to-like facility basis, if we leave out the additional facilities like colony and things which we might or we might not construct, or we have not taken a call on that. So on a like-to-like basis, it is expected to be around 18,500 crores. That is the first cut. We have not yet confirmed the exact revised cost estimate, but we are looking at it and we are discussing it with Macon right now.
Fabulous. So you mean to say that on a like-to-like basis, if we are going for 18,500, we are not required to take any additional debt burden for completing this steel plant?
So as of now, we are comfortable with the cash position to invest in Nagarnar, because this year we are planning to invest around 2,200 in Nagarnar. And the entire investment is planned on our own resources this year also. So that will take it to almost to the final end. I don't think we will need to resort to the debt as of now. As of now, our cash balances are comfortable to service the investment and the possible working capital and other revenue requirements of that.
Just final question based on what you replied, and then I'll come in the queue. You mentioned about, pressure filter replacement. So how much will it cost if we are, replacing that?
It's not a major investment. It's around around 15 to 18 crores. It's not that major an investment, but we need to finalize the technology because this entire plant was designed with a particular type of pressure filter, right? It had a particular size, it had a particular slot, it had a particular volume, and all those. Now, we need to go back to the conventional pressure filters in which all the pellet plants normally work. That's not a new technology. But how do we slot it in our own plant is the challenge. So the technology of the new pressure filter, which is a proven technology, is not a problem. So it's the ballpark estimates are anything between 12 to 15 crores. At max 18 crores.
Got it, sir. Thank you so much, and I'll come in the queue with additional questions.
Sure.
Thank you. Next question is from the line of Ayushi Mohta from CDQ Research. Please go ahead.
Good afternoon, sir. Sir, how much will be the Chhattisgarh mine production target this year?
Chhattisgarh production last year was how much? Chhattisgarh as a year as a whole was around 10 million ton from Kirandul and around 12 million ton from Bacheli last year. So this year that's around 22 million ton. We expect to do around 24 in these two, 24 to 5. Anything between 24 to 25 million tons from these two mines taken together. And that is the 25 plus 7 is the Kumaraswamy, which is the Supreme Court cap. And that is how our guidance of around 32 million ton is being worked out as of now.
So Kumaraswamy even has a capacity of 7 million tons, right?
No, it has a capacity of more. But we can actually ramp up to 10 in a short notice. But the Supreme Court cap is 7. In Karnataka, there is a Supreme Court cap. In the Ballari region, the Ballari hospital region, the maximum capacity is 35. That is the Supreme Court mandated cap. Of 35, I had 7 for Kirandul, 7 for Kumaraswamy and 7 for Donimalai. So out of that 35 million ton, my NMDC cap was around 14 million ton. So of course now that Donimalai has closed, so that is there. Obviously, Kumaraswamy being a new mine, if we are given 6 to 8 months or maximum a year, we can ramp up the capacity. That's not a problem. But we have a Supreme Court cap there, imposed cap, based on environmental concerns there. So that's a different story.
Okay. And so where do you expect to sell the extra production from Chhattisgarh?
No, we have enough. The market is not a problem at all. You see, even our major customers, we have 3 or 4 major customers if you see. One is RINL, right? Rashtriya Ispat Nigam Limited at Vizag. Now, they are ramping up their production from earlier 3 to 6, now 6 to 10. So, they are, then we have a big one at SR. SR is also now debottlenecking and going up. JSW is another big customer. JSW at Dolvi. So these major customers are all ramping up their production. So we have no problem with the market as such because if you know that we sell the best quality of ore not only in India but also in the world. From the Bacheli and Kirandul it is 64, 65 plus. So the sale is not a problem even in Chhattisgarh market. We have a big market there of around 4 to 5 million ton, of which we service now around 2. So there is a lot of scope even in Chhattisgarh. So that's not, the market is not a problem. Whatever we can produce and mainly the constraint is evacuation. We are investing a lot in evacuation. If the evacuations are actually going up, then we can actually sell more. Market is not a constraint here, so far as Indian is concerned.
So the majority of the production will be sold to your existing customers itself? Like you mentioned.
Yeah, but these 4 or 5 big customers account for us around 65 to 70% of our sale.
Okay. Okay, sir. Thank you so much.
Thank you. We take the next question from the line of Anuj Singla from Bank of America Merrill Lynch. Please go ahead.
Yeah, thank you very much. Sir, first question on the pricing. While there has been a sharp increase in the global pricing, and we have also taken a price increase last week, but our pricing has significantly lagged the movement in the global iron ore prices. So is it more related to the overcapacity on the Orissa side, which is inhibiting our ability to increase prices, or any other indicator which is impacting the pricing in the domestic market?
Let me give you a little background on this so that the entire situation on the pricing is a little more understood. Because whenever I talk, I feel that there's a lot of communication gap in pricing. First, we need to understand that the Indian prices are not exactly completely, but directly not linked to international prices. Now, why is that? Because anything above 60% Fe in India attracts export duty of 30%. So that makes immediately the possibility of export almost unviable. It doesn't make sense to, you realize more by selling in domestic market rather than selling in international markets. So how do international prices help us? If the international prices go up, the Chinese steel making prices go up. If the Chinese steel making prices go up, the likelihood of Indian steel prices moving northward is also there. Now, once the Indian steel prices move up, our prices are more or less move in tandem with the Indian steel prices. So there will be a lag between the international prices moving up and our prices moving up. That's number one. Number two, if you see, our cost at East Coast is around 35 to 40% cheaper as on date than the international spot prices, and in the Western Coast it will be around 25 to 30% cheaper. If you go into mid-country, the difference would be cheaper by around more than 50 to 60%. But you must also realize that India is only the country in the steel scenario where we have very substantial ore production capacity. We produced 215 million ton last year, and a very substantial steel making capacity. We produced 107 million ton last year. Now, if you take the other countries, Brazil, for example, they export 400 million ton. They don't have that amount of steel making capacity. Australia exported 880 million tons, but they hardly have any steel making capacity. Now, if you come to Japan, so Japan produces more than 100 million tons of steel, but they have no ore at all. China produces around 1350 or 1400 million ton of steel with hardly any ore resources. So India has a very unique place, and if you see the national mineral policy which was published around a month back, Para 6.1 also states that the ore, and not only iron ore, any ore should be applied for the requirement of the domestic industry first, not only the present requirement but also future anticipated requirement, and then should be seen in any other case. So out of the 215 million ton that the country produces, almost all is consumed within Indian steel making capacity, Indian steel making requirement. And Indian steel making requirement is likely to go up to around, the capacity is supposed to go up to 300 million ton of capacity in 2030, and it should produce around 260 million ton of crude steel. So the likelihood for the Indian requirement is in 2030, as per the national steel policy, is 437 million tons of iron ore. So since the consumption is going to be completely within the boundaries of India, so I think, and with the export regime that it is, and this has been there for the years, so it's not a new policy of the government, it has been there for years. So the chances of export prices influencing the Indian prices in the immediate or the short run, I think it is not there. Unless, as I told you, the circuitous way of Chinese steel making prices going up and then the Indian steel making prices going up, and then our ore prices moving around that.
Yes, sir, I understood. Sir, actually, I was asking from the import parity perspective on the Western Coast, where your key customers are located. Like you mentioned, it's at a sharp discount.
So we will, our landed cost on today's prices, if you see, it is around $87 in the West Coast. $45 is what I charge. $9 is your royalty, that's $54. $19 is what railways charge to take it to Vizag, so that's around $73. $4 of port charges, $77. And around $8 of again shipping charges. So that's around anything between $85 to $86. And imported would be around 108. It was yesterday 106 today. You add 2.5% of import duty and around 4%, $4 or $5 for the shipping charges because we use Panamax ships and not Capesize. So that's a clear mathematics. It's known to everybody. So we will be in the western coast around $85, and they will be around, let us say, around anything between $110 or $115, something like that.
Okay, so that is not the deciding factor for you at the moment. It's, so the follow-up question actually is China, like you mentioned, the higher iron ore prices should actually lead to higher steel prices, which is not happening. China steel prices have actually declined
yes.
over the last 1 month. So obviously, lower China prices will lead to lower steel prices in India as well, maybe, next month or the month after.
We normally, of course, you see, also Odisha is a big concern for us because with 2020 coming in March and all the leases expiring, the chances of what is being anticipated is that a lot of these mines will actually ramp up their production very substantially. They, out of the 215 million, they did 110 to 115 million this year. They account for 50% of Indian iron ore production. And if there's a significant increase in production there, so naturally there will be a pressure on domestic prices very, very hugely, because they would like to squeeze every ton of production out of their capacity, and when the leases are, we are keeping a close watch on the Odisha market, and yes, Odisha market does impact our pricing strategy rather directly to that extent.
Okay, understood. Thank you very much, sir. Thank you.
Thank you. Next question is from the line of Vaibhav Vajatia from HNI Investment. Please go ahead.
Hi, sir. Thanks for providing the opportunity and congratulations for a good set of numbers.
Thank you.
Just two questions. One is that what is the amount of investment that we have done in railway sliding work this year?
Railway sidings. Railway, no?
Yeah.
Right. Railways, actually, if you see, we are making an investment in two places. One is the doubling of the KK line between Kirandul to Jagdalpur. That's around somewhere around 120 kilometers, approximately 120 kilometers.
Right.
It is being done in three phases, around 40 kilometers each. One 40-kilometer stretch is complete and commissioned. The other 40-kilometer stretch, I think the progress is around 30 to 35%. And the last, which is between Kirandul to Salak Johari, is another around 40 kilometers. The progress is slow there. It is around 15 or 20%. The total envisaged investment for this is around 1,200 crores, of which we have already spent around 650 crores. So another 5 to 550 crores is what is due. What this will do is that this will increase the capacity of evacuation from the current 28 million tons through railways to 40 million tons. And that is a very vital part of our expansion plans that we have to move to 67 to 70 million tons in 3 to 4 years. So that is a very vital component for us. The other investment is we are making from Jagdalpur to a place called Ambagaon. That's only 25 kilometers, but that is more to link our steel plant. That was around 250 crores, of which we have spent 200 crores, and the project has been already completed. So we made a savings of around 50 crores. So these are the two railway investments that we are making. Of course, we have a JV between Jagdalpur to Raughat, which will connect the Raipur, but that is a separate company called BRPL, Bastar Railway Private Limited, where we are one of the major shareholders of around 51%. So that's a different perspective altogether, that if we have a line up to Raipur, then we might, in the future, in 5 to 7 years, might have a easier access to the Raipur market, which is currently at 4 million ton or 5 million tons.
Right. I was coming from point of view of your P&L. I think, this investment under Ind AS is getting written off into P&L every year. So I just wanted to confirm that what is the amount that is charged to profit and loss loss for this railway sliding work for the current year, financial year 19?
Just a minute. इस साल हमने कितना राइट ऑफ किया है, इसमें कितना पीएनएल में कितना किया है रेलवे का? हाँ. I'll give you the exact figure in a minute. Yes, the accounting, since it is an enabling asset, since the asset does not appear in my books, so the accounting treatment is, of course, that we need to charge it off to profit and loss account as an expense, because we cannot create an asset out of that. It cannot appear in my books. The exact figure of this year is, I think, some around 100 and some crores, but exact figure I need to just give me a minute. Just give me a second.
Yeah.
But, just let me find out. This year we have charged around 195 crores.
Okay, around 200 crores. Okay. And second is, on the mine closure expenses, what is the total expense for the FY19, and what is the normal level of mine closure expenses that we can expect on a normalized basis every year?
Mine closure, this year it was 54 crores, because that is 1 rupee per, I think, the charges are 16 rupees per ROM, something like that. Last year we had to pay 35 crores extra because some prices were changed by about 1 rupees and we had to pay with retrospective effect. So around 35 crores was paid more in last financial year. A retrospective charge which was not there this year. This year the current charges are 54 crores on mine closure charges.
Okay. And this is what we can expect on a normalized basis going forward as well?
This is the normal one, because last year 35 crores was extra because of retrospective increase in charges. By about 1 rupee per.
Okay, got it. Thank you. That's it from my side.
Thank you. Next question is from the line of Dhruv Machal from Motilal Oswal Securities. Please go ahead.
Thank you. Sir, can you, a few of our Chhattisgarh leases are also expiring in March 2020. I see from your presentation. Any update on that, and have they done, and can it also be a case similar to Karnataka? Any color on that?
No, if you see our presentation, one of our major leases of 11, they have been renewed under the new laws in 2017 for 20 years. So that precedence is already there, and that is why we are fighting this case at Karnataka, because the same law, the same act, the same rules, we have already got an extension in 2017 for one of our major mines there. That is Deposit 11. So naturally the state government would, the Chhattisgarh state government doesn't have any problem renewing that. They have not asked us for any such things. We have made an application, and as you know, as per the MMDR Act, we are the only company, being the government company, who are entitled to such renewal on one-to-one basis. In an auction route, you are not very sure whether you will get your mine or not, but in this renewal route, we are pretty sure that this mine will be renewed for us.
Sure, sir. This is helpful. So, secondly, on the steel plant, if you can give some detailed color on how is the status of, say, Sinter plant, coke oven individually, that will help us better understand when the project is likely to, start producing.
You see, the Sinter plant is ready. The coke oven is ready. We can do the battery charging anytime we wish. The only problem that has arisen in this year is we are facing a little bottleneck. We were facing a little bottleneck, and which was running behind schedule, is the byproduct plant. Now, unless the byproduct plant is ready, we cannot obviously start heating the coke oven, because the gases would need to be processed. So only the byproduct plant was the one that was going a little later than expected. Now that is expected to be commissioned in about 2-3 months time, 4 months. Once that is done, the rest of it is ready. And the material handling, the other problem we were facing was at the material handling side. That is the raw material handling side, where more than 50% is now ready. The entire, a little bit of coke route is left. So once that is done, so these were the two basically schedules that were running behind schedule. The rest of them, be it the blast furnace, be it the thin slab caster, be it the SMS, be it the coke oven, everything otherwise is already ready and ready for commissioning. Once these two are completed, and we are completely focused on these two now, once these two are online, the entire plant can be commissioned.
So, you mean BAF, center, everything is 100% civil work, everything is done?
Yeah. But no other packages except these two, except the fact that the byproduct plant. In fact, we had started the chimney heating for the coke oven, hoping that the byproduct plant would come in time. Now, of course, we have gone to certain of the subcontractors and dealing directly with them to complete the byproduct plant.
Sure, sir. And so the iron ore for this plant is linked to one of your own JV-related coal mine, iron ore mine. So is that also up and running? And if, so for example, that is delayed, can you source the iron ore from outside for that while?
Yes, please understand that JV mine is not a captive mine, so as to say.
Yeah.
It is linked with it, but it is not a captive mine. For example, SAIL cannot sell their captive production to anybody else. I am free to sell it to the JV company where I am a 51% partner and the Chhattisgarh government is a 49% partner. They are free to sell it anywhere else also, but also give it to to our steel plant. So, if, of course, I am told that that's a separate company, but I am told that there is progress on finalizing that. MDOs have been appointed and all. But even if it is delayed by some time, that ore will not be a problem because we have enough ore to feed our own plants.
Sure, sir. So I have more questions. I'll join the queue and hope you keep doing such calls regularly. This is very
Yes, sure.
Thank you. Next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good afternoon, sir.
Good afternoon.
Sir, I just want to understand that you have said that your railway evacuation capacity is already somewhere around 28 million tons. And in Chhattisgarh, we had already had the capacity of 30 million tons, but we have always managed to do much lower than that. So is this a specific reason why we are not being able to evacuate more material from Chhattisgarh despite capacities in place?
You have to understand that we already have a 8 million ton pipeline of SR, right? So out of my Chhattisgarh production, 6 to 7 or some 7 tons goes through that pipeline to Vizag, which SR buys at the mine head. Now, unfortunately, although the capacity is 28 for railways, most of the time there is no night working, right? Because of the law and order problem there. Most of the time, it works only in 2 shifts. So the railway doesn't work from evening to morning. Most of the time. So the effective capacity actually gets down by 1/3. Unfortunately, it gets down to around 16 to 18 million ton. And that is what we do. We do around 16 to 18 rakes a day. So we are, to the extent working is possible, we are right at the maximum working possible. Now, because of law and order problem, because of track damages and all, sometimes you see normally the night working doesn't happen. So, effectively 28 is actually, although it is 28, effectively it becomes 18 or 19 and we are doing 16 to 16, 17 depending on the availability of the rake, 16, 17, 18 through that. And hardly 1 million ton is through road. That's not really much.
So this 22, 23 which you have done this year, you are talking about 2 million tons extra. So where would be the additional evacuation you are expecting?
As I told you earlier in this Concall, that our major customers are in a very substantial way they are upgrading their capacity. RINL has gone from 3 to 6 and is going up to 10. JSW Dolvi is increasing. SR is debottlenecking. It has not done around more than 5 or 6 million ton earlier. Now SR is supposed to go up to 10. So we have, these are major customers, 4 or 5 major customers who account for around 70% of our sales. Their demand is going to go up substantially. In fact, we are in a hurry to complete our evacuation project so that we can meet their requirements when their expansion is done. Apart from that, Chhattisgarh market itself is quite a big market where we have some presence, but that's quite a big market itself, quite a substantial market in itself. So we can increase our foothold there as well.
Oh, sir, basically I'm not concerned about the demand, but the additional evacuation facility of 2 million tons which you would be guiding, so it would be largely from rail, or we would be taking more of a road transportation?
It will not be 2. It will go out from, the rail capacity will go increase from 28 to 40. So that's 12.
But that is after 2 years, right?
Yeah, around 2 years. And
but our guidance is for this year.
This year it will not be a problem because SR, although the capacity is 8, they take around 6 to 7, 6.5, that is where they... So we have a million ton spare capacity there. The railways can give us 2 more rakes, so that will be 2 million ton. 1 rake is more than a million ton a year. So railways is now coordinating very high. If you see the evacuation in April has been an all-time high. It's 2.9. It has we have carried the momentum of March previous year to April this year. It has never been 2.9 ever, and even if in the Chhattisgarh sector it has been more than 2. So this has never happened in our history. So there is capacity. The railways can squeeze in a couple of more rakes within these area, and we are also now putting in what is called a rapid wagon loading system at our Kirandul facility. So that will also facilitate easier and quicker loading of rakes from one of our sidings in Kirandul. So all these are going on, and 2 million ton is not really a major challenge for evacuation, especially given the SR pipeline and the railway.
Understood, sir. And sir, secondly, we are reporting expected credit loss every quarter, and the amount has roughly around 250 crore for FY19. So if you could just give us some sense on what is exactly, what kind of provisions we would be taking and going forward on that, because this is started last year only.
No, this has been there for the last 5 years. The story behind this, let me give you a little background. You see, when the entire mining was banned in Karnataka, we were the only miner allowed to mine because we are a responsible miner and all. So there was a specific Supreme Court judgment which allowed us to mine. The only thing is there that what happens is the entire auction amount goes to the monitoring committee. Okay. Now, monitoring committee keeps back 10% and gives us the 90%. Now, this 10%, for this 10%, of course, we'll have to approach the court and we'll get it. But we'll have to write it off because as of now, for the last 4 or 5 years, we have not got it because of certain procedural problems, so we write it off. Now, for the others also, the monitoring committee, for other private miners also, the amount goes to the monitoring committee, and the monitoring committee then releases it to the private miners. So the system is the same for us, except for us, because we are guided by a different Supreme Court judgment and not the other Supreme Court judgment, where Supreme Court has now allowed 100% to be refunded back to the private miners. So we are now will have to approach the Supreme Court saying because you have already allowed it to the private miners, kindly allow it back to us. So it is a matter of judicial approval needs to be taken. But since we are guided by a separate judgment, as of now this 10% is being retained by the monitoring committee towards various issues. So that is why we write off this 10% of expected credit loss every year. And this has been being done for the last 4 or 5 years. Ever since the time this thing as Karnataka mining ban was there. And the current expected amount that we will recover from the monitoring committee, subject to Supreme Court approval being obtained, is around 1900 crores, 1935 crores. So once the Supreme Court does allow us to refund, exactly the way it has already allowed the private miners, we will be richer by around 1935 crores. But when that happens, it depends on how early we can get the Supreme Court to hear it, because this is with the Supreme Court.
Understood, sir. And sir, lastly, if you can throw some light on the, this collector's demand of Datewada about 7,240 crore. So,
no, let me clarify. It is not a demand. It is a show cause notice. Yes. So, the demand comes much later than a show cause notice. Of course, we have given the reasons why it should not be. The legal opinion that we have is that this common cause judgment, it comes from the common cause judgment, is not applicable to Chhattisgarh. Sale, whatever provision has been made for only Odisha mines and Jharkhand mines. It has not been made for Chhattisgarh mines. In fact, the government of Telangana has moved court against this common cause judgment. The government of Telangana has said we will not implement this, and in fact we don't want this implemented. There is again a lot of petitions have been filed at the Supreme Court. Even at the ministry level, a lot of petitions have gone whether that this common cause judgment should be made applicable irrespective of the type of mine, irrespective of the type of violations, irrespective of the location of that. So we are very clear in our view that this is not applicable to us, and nothing is payable on this account. So this demand this show cause has not been converted into a demand as of now.
Okay, sir. Thank you, sir. That's all from my side. Thank you very much for taking my questions.
Thank you. Next question is from the line of Nitin Agarwal from JM Financial. Please go ahead.
Yeah, thank you for taking my question. Sir, most of the questions are answered. Just one thing, in the 4Q, why is our cost per ton so low? Is there any one-time, specifically in royalty per ton FEC, it has come down significantly in Q1?
Yeah, royalty, what happened is what we had made a provision last year, which has been written back, that's around 165 crores. So you will see that the royalties have come down as compared to last year. It's because of some amount of production loss. But yes, around 165 crores we had made a provision, excess provision last year, which we have adjusted this year. So there is that, if you want to compare, it will be around 165 crores you'll have to take into account, that benefit that we have got this year.
So this is
that has happened in Q4 this year.
This is one-time reversal.
Yeah, this is a one-time reversal.
Yeah. Okay, thank you.
Thank you. Next question is from the line of Sarvesh Gupta from Maximal Capital. Please go ahead.
Sir, thank you for taking my question. So my question is, there is a chance, I think I read in some media reports that the government might ask you to divest the steel plant. So if in case that happens, what can be the timelines for it? And secondly, what will be the company getting as for compensation for the same?
Look, we cannot comment on government policies. This is beyond the purview of the board. So whatever the government decides, we as a government company where the government has 72% stake, we'll to go by what the promoter says. But whether good, bad, when, how, are matters which are beyond our purview to either speculate or to even guess.
Understood, sir. And secondly, sir, given that we have around 4,000 crores of cash, plus we'll be generating some cash, but we also have around 3,500 crores of capex for the plant which is required to be commissioned, plus some other capex. So what will be the guidance for dividends in this year?
Number one, yes, we have 4,600 cash last year. We will generate again cash this year. So, and we are comfortably placed so far as the capex plans of 3,000 crores this year, and maybe some working capital requirement that will be there for the steel plant. So that we have that covered. Normally, the dividend policy is done by the government, and the policy as on date is that you need to pay 30% of your PAT or 5% of your net worth, whichever is more. And that is the minimum payout. We have been paying our promoters around 39 to 45% over the last few years, because we are one of the most highly profitable companies of the government. Last year also we did a buyback of around 1,000 crores, which we cannot do this year because obviously you can't do it in within 12 months. But obviously the dividend will be at least 30% of our PAT. That is the government mandate. There's a very specific rule which is applicable to all public sectors and not only us. But generally we pay around 40% of our PAT. Some around anything between 39 to 45 has been the history. I think more or less that should be the first cut speculation. If you or I were to speculate, so that should be anything around that.
Sir, in the presentation you have said that the steel plant would produce around 1.7 billion tons worth of steel at 25% EBITDA margins. So, will it be fair to assume that this would be like EBITDA of around 3,000 additional crores will come in at full capacity utilization?
No, not this year. Not this year.
But in the coming years.
Yeah, in the coming year, the steel prices hover around 43, 44. We expect an EBITDA of around 25%, 20 to 25%. That depends on we are taking up steel prices for our products at around 42 to 44,000. So by that we should get an EBITDA of anything between 20 to 25%. That depends again on the steel price. Naturally, if it is a 3 million ton plant, and we will do around 2.7 year after next when it is completely full ramped up. So by that mathematics, it is around 10 to 12,000 crores, and an EBITDA of around 25% of that. That's around 2,500. That is what the expectation is.
Understood, sir. Thanks a lot and all the best.
Thank you. Next question is from the line of Ashish Kejriwal from IDFC Securities. Please go ahead. Mr. Ashish Kejriwal, your line is unmuted. Please go ahead with your question. There seems no response from the current participant. We take the next question from the line of Amit Dixit from Edelweiss. Please go ahead.
So thanks for taking my question again. Just on steel plant, wanted to understand how you are planning to operate the steel plant. Are you planning to operate it on your own, or you have identified it to be operated under operation and maintenance contract? And if so, who will be? Has it been finalized?
No, it's a mix and mixture of all. We were for construction. We had around 400 of our own people placed there. Now that the commissioning is almost done and almost done, we have hired another 800 people with steel plant experience. And now this hiring is basically right from the top, from the ED level, people who have been in SAIL, people who have been in RINL and JSW, in SR, people who have run the steel plant, right at the top, to around middle management of senior managers and DGM, to the new people of around managers and deputy managers. So 800 people to run the plant. We have already recruited. They are at Nagarnar as we speak. They have already reported at Nagarnar. They are seeing the facilities so that they can advising us what final touch-ups are required, what final things are required. In addition to that, we are also floating around for 30 to 40 O&M contracts, which will be supervised by these people. So another, say around at least 2,000 people or 3,000 people maybe would be made available through the O&M contracts. And these O&M contractors are also very experienced contractors, because that is how the pre-qualification criteria were made, so that these people also have at least 1 million ton or 2 million ton of steel experience in such plants. So it's a mixture of all three. We have some permanent cadre, around 400 of them, 800 we have recently recruited, and around 3,000 3 to 4,000 will get from our O&M contractors.
So it's fair to assume that at full capacity you will be having 1,200 of your own people and O&M guys of around 2,000 odd people working there.
It will depend on how the O&M contracts go. Once we get more experience in running the plant, we might replace O&M with our people. So that's let's see how it goes. If O&M is cheaper and if it is more effective and it is more, then we'll possibly continue with the O&M. But the O&M is for the first 2 years. We are entering into a 24-month contract with these O&M people who have blast furnace experience, people who have coke oven experience, people who have sinter plant experience, and all those. So let's see how it goes after 2 years, and then we'll take a call. If we have to renew the contracts, we would do so. If by that time we feel that we'll be better served by having more of our own people, we'll take that call around 1.5 years once the plan starts, so that we can take that.
Okay, the second question is, can you give the capex guidance for this year and the next, and split it into steel capex and non-steel capex?
Yeah, the total capex guidance this year is around 3,000 crores. Of which 2,200 crores is for steel. For Nagarnar it is 2,200 crores. For the rest it is 800 crores.
Okay, this is for this year, 4,000 crores. 3,000 crores. But you said
2,200 plus 800.
2,200 plus 800. And next year?
Next year, I think Nagarnar would be a little lower, because by that time we would have done all the commissioning. We expect a lot of payments because our contracts require 12% retention, which is to be paid on commissioning. So we believe out of this 2,200 crores, a lot of money would be because of the commissioning payout where the last installment is paid. So next year, Nagarnar should be not more than 1,000 crores. If we manage to pay around 2,200 crores this year, so it will be around 1,000, 1,200 crores in Nagarnar, unless we decide to have more facilities in terms of colonies and other things. That's a different issue altogether. But by that time, we expect that the 3,000 crore slurry pipeline would be on full swing. So that should consume at least 1,000 crores next year. So I think our next year capex guidance should be around ballpark estimates. We have not done a final estimate. The ballpark estimate should be around 2,200 to 2,500 crores. But these are not very firm figures.
Okay, wonderful, sir. Thank you and all the best.
Thank you. Next question is from the line of Jayesh Gandhi from Harshad Gandhi Securities. Please go ahead.
In 2020, when mines will be auctioned and maybe bid by our own existing clients, what is your view on the volume that which we can? I mean, can we continue with this kind of volume, or a volume can shrink?
No, our volumes will not shrink. That's not a problem. We need to get clarity on the auction process first. You see, the auction process is in two parts. Please don't mix them up. One part is the captive auction, which has a separate set of rules, separate set of eligibility, separate set of rates. So that is not coming up. When it comes up, it will be on a different footing altogether. What is coming up in Odisha, which will likely to affect us either in a very good way if there is a non-renewal, or there are problems in takeover or handing over and all those, so our ore would be much in demand. Or if there is a very high production, then we'll face a lot of headwinds, because they will like to liquidate their production on much reduced prices. So the merchant mining auction is on a completely separate route. The people like SAIL and Tata's already have sourced their material fully from their own captive mines. So far as one of our major clients are concerned, that is JSW, they are also bidding for mines, but the way they are expanding, they will still require more ore from us, what they consume, even after their production is whatever captive mine they have taken. Even if it is producing, so they will still require ore for us. And plus there will be new clients, so because of our quality of ore, which is 64-65% plus in the Bailadega sector and 63 and 64% plus in the Karnataka sector, because of the qualities, we are not going to face any problem.
Can you just help me out in understanding what kind of a quality will be there in those Orissa mines?
Odisha mines, except for one mine, I think the Rungtas also do have around 64 to 65%, but they are around 60 to 62%. Most of these mines are between 60 to 62%. Mostly that is the general grade, except I think one producer which has, if I recollect rightly, I just don't recollect who such the producer is. It would be either Sirajuddin or Rungtas. They have fairly good quality ore of 64-65%, but ours is 64, 65, 66, sometimes 67 also. So our quality of ore is very, very good in the sense it has much lower alumina content, much lower silica content. So overall, the quality of ore it's one of the best, not only in the country but even in the world.
That's all from my side, sir. Thank you very much and best of luck for the future.
Thank you.
Thank you. We take the next question from the line of Dhruv Muchal from Motilal Oswal Securities. Please go ahead.
So thank you. Most of my questions are answered. Just one last thing probably is, if you can comment anything on this, do you think on the Donamalai case, they can go to the Supreme Court rather than just stopping here? Is that possible? I mean, probably it is. But
number one, we don't expect to lose. Okay. So we'll any litigant would expect to win. But
the Karnataka government, if they can go to the...
I always say in all the forums that I talk that my risks for Donamalai is coterminous with that of the industry. Now, you see what will be the long-term effect if we were to, let us take the worst case example. What is the worst case situation? I lose at Karnataka, I lose at Supreme Court, I lose everywhere. This is the worst case scenario. Mm-hmm. Now, what is the implications of that? So then 85% becomes the benchmark for allotment of any mine through auction. Any merchant mine through auction, whether be it Odisha, be it Karnataka, be it Madhya Pradesh, be it Jharkhand, be it any state. In the regime of CVC and CAG and all these institutions, once a market-determined price of 85% has been determined, I don't think it is possible for any government to award at anything below 85. And 85, no merchant miner can survive because you start with -2% and your cost of production is again minus. So that will be the end of merchant mining completely. Now, apart from this big 4 and 5 who do around 50-55% of the steel production, that is JSW, Tata, and RINL and SAIL, 45% of Indian steel making capacity is in the small scale sector, which depend on which is called who depend on merchant mining. Now, there will be no feed to them. So you are actually talking in terms of loss of steel making capacity of 40 to 50% if Donamalai were to go at 85% and we lose everywhere. Now, that is an economic cost and a political cost that possibly the country cannot take. So it's like somebody telling me whether China can invade France. Possible? Yes. Probable? Certainly not. So the possibility and probability, I think, so our risks, this is not a company-wide risk. This is an industry-wide risk. This is a risk to the entire steel industry, and it has implications that possibly the country, either politically or economically, will be impossible to handle.
Mm-hmm. Got it, sir. Sure, sir. Got it. Thank you. Thanks a lot.
Thank you. Next question is from the line of Yash Doshi from SBI Cap Securities. Please go ahead.
So thanks for the opportunity. So just one clarification on your earlier comment. You said the Odisha mines which are coming up or which are due for expiry and coming up, will the new mines be only for merchant mining or it will be mix of both captive and merchant mining?
No, you see, merchant mining will be auctioned for merchant mining. Captive mines will be auctioned for captive.
So, but none of these, those who are expiring 20 are captive. All of them are merchant, if my understanding is correct.
Most of these are merchant. I think the captives are also getting auctioned some of the captives are also getting auctioned in 2020. But that would be within the captive. That would be within the captive basket. So as a merchant miner, somebody like, let us say, one producer in Odisha like Rungta or maybe Sirajuddin, they cannot bid for those mines because they don't have the steel making capacity. They don't have steel making facilities. So that's a different basket. Some I understand if what I recollect rightly is that some of the captive mines are also to be auctioned, but they will be within the captive basket.
So, but our street understanding is most of these mines which are coming which are producing roughly around 120 million tons
these
ore.
These are merchant minings. These are merchant minings.
So even the captive players can bid for it?
No.
Legally.
Captive, they can bid as a merchant miner. But nobody stops sale from bidding on a merchant mining thing. So the captive miners have an advantage of bidding on I have not seen the pre-qualification as of now. I have not read the pre-qualification. But if I were to understand it, there is no restriction for a steel maker to bid for an captive mine. But I haven't read the fine print. It appears from that, but there could be some restrictions where, because inherently the captive mining rates will be much higher. So that will possibly not make a level playing field if you are a merchant miner and if you have some steel plant to fall back on. So I think some restrictions will be put, because otherwise it does not give you a level playing field. So that would create a problem.
Okay, so just a follow on this. So assuming that the merchant miners will kind of extract as much as possible, kind of reaching the EC limit. So, is there any, or do you have any sense on the you can say the ending stock of these merchant mines? How will that be treated, and whether that can allow in the interim, if there is some mismatch in the timelines of handing over to the new owner, that can support the you can say the production disruption in the interim?
No, I think after 2020 March, no miner will have the what you call as the right over the mine, lock, stock, and barrel. Even if they have stock, I don't think it will belong to the earlier miner. I don't think that's going to happen. Okay. What we are anticipating is, you see, Odisha has already gone up from 101 year before last to 110 to 113 this year. So that's a 10 million ton. That's a 10% increase in there. So we are expecting that that amount of ramp up would also be there this year. And they will then have to liquidate their stock, knowing fully well if the stock is retained in the mine head, it will not be their property anymore. So naturally their intention would be to liquidate it before 31st of March. And with that amount of ramp up, the only way, not the only way, but one of the ways could be that you cut down on prices. And we are looking very closely at that, because that is going to be unwelcome news for us if the Odisha miners actually reduce a lot of price to liquidate their stocks before they hand over the mines.
Okay, sir. And my second question is a bit off track. What is our view on the investments which we have done in various subsidiaries and JVs? Our presentation has suggests that we have done investment roughly around 940 odd crores, but I guess we are not yielding anything or hardly anything from that. So how do you view, or do you think there is any scope for divestment, or is there any scope for further investment in it?
Well, there are two types of investment, if I may say. One is we had made certain strategic JVs with the state governments. Right? The state governments want us to build steel plants, for which we can get some private partners and back to back. So they have made a JV with us for giving mining leases on merchant basis, which is our basic interest. So with the state government of Karnataka, we have two JVs where we have already bought there's a huge tract of land which has been allotted to us, around 700 acres of it, all fenced. And so we have one JV for steel making, another JV back to back for mining. With the state government of Jharkhand also, we have a steel making JV and a mining JV. So these JVs are made for strategic reasons, as and when the mines are allotted to these JVs. You see, Chhattisgarh has already allotted one mine to JV. That deposit 13 has been allotted to one of these JVs. That is the NCL, NMDC CMDC Limited, right? So, as a matter of strategy, we have so naturally the land has been there, so we have paid in advance to that around 600-700 crores. So that is an advance that is there. But these have been made for strategic reasons, because if you want to increase, and now the state governments insist that not only royalty, but they want to partner us in the mining activities, and we can help them to find a partner for making steel. These have been investments in this strategic domain. One has already paid off in deposit 13 in Chhattisgarh. We hope when the mining, because these being government companies, are entitled for getting mine leases on reservation basis. So we hope that we'll get that on reservation basis. So that is why, for strategic reasons, we have done. We have also invested in what is called the BRPL, or the Bastar Railway Private Limited, for around 140 kilometers of line between Jagdalpur to Raughat. Because the railways and SAIL is already making it from Raipur to Dalli Rajara, it is already there, and Dalli Rajara to Raughat they are already making. So if this 140 kilometers is made by us, JV made by us, it will give us an access to Raipur market. So for that reason, we have invested around for land acquisitions for. We have invested, I think, some around 100 or some odd crores, 168 crores or something like that. I just don't recollect the figures. But these are for strategic reasons in terms of long-term growth plans for the company. So far as our international investments are concerned, now we are looking closely at them. We are looking to operationalize them. Especially in Australia, that is one thing that we have, believe that gold could make a little bit of sense. So we are trying to up our investment in Australia through our subsidiary called Legacy, where we have already invested around 168 crores till date, where to maintain the mines. We also have iron ore tenements there, but that is in the long term. We are not looking at the iron ore in the medium term right now. We also have investments, but that is a direct investment in Tanzania, and where also the gold prospects look fairly well. So we are investing around 10 crores in this financial year to get to a level of position where we can take a call whether we should invest further in gold in Tanzania or not. So these are various things that are there. Krishnapatnam Railway also, we have a JV where we have invested around 40 crores for a shareholding of around 15%. Now that would be gateway of both export and import if the exports are allowed from Karnataka in some future point of time, or even maybe an export or import of materials for our steel plant. So most of these are for very strategic reasons. Our JV at ICVL, where we had spent around 376 crores, is already producing coke, and it is a JV with SAIL and RINL and all the steel producers in India in the PSU domain. So that's already producing coal there.
Okay, sir. Thanks a lot for the elaborate answer.
Thank you. We take the next question from the line of Basant Joshi from IDFC Securities. Please go ahead.
Yeah, thank you for the opportunity. I have a few questions. So with the recent global prices for 62 Fe at $107 and 65 Fe at above $120, can we expect similar gross realizations from our export sales?
Yes, export sale, what has happened is that I'm so happy that you asked the question. I completely missed this point. You see, all our exports of all these years were benched to 62 Fe, Platts Fe. Right? What are the export prices? These are basically last quarter average prices with 1 month lag. So, but they were benched to last quarter average prices of 62 Fe. Now, earlier, if you know, you are from the industry, that the margin between 62 and 65, the spread was not much. It was $3 to $5. And naturally, because we use Panamax vessels rather than Capesize, so normally it takes care of that $3 to $4 is because of that. So there was no incentive. Now, around 6 months back, we, of course, our team went to Japan, including me, and we went to Korea, and we renegotiated the entire deal so that now we are at benchmarked to 65 average prices rather than 62 average prices. And the last 5-6 months, the average spread has been around $13 to $14 between 62 and 65. So that is a benefit. Of course, we will lose around $3 for the vessel size difference. That is what we lose. And for the alumina content and as per the Platts formula, we lose another $2 or $3. But still, if the spread is around $14 to $15, we are likely to gain $8 for every ton that we anything between $7 to $10 for every ton that we export. So if we take it 3 million tons, and if we take it in the worst case scenario $7 a ton, so that's around $21 million. That's a fair amount of money around. If it is a good day, well, it could be $10 and it could be around $30 million US dollars. So that is the difference of export realization that we'll have this year as compared to last year. And the new arrangement is effective from 1st of April.
Okay. Thank you for the elaborate answer, sir. So my next question is, we took the price hikes on 25th of May, and then there is another news that Odisha miners have taken second hike in prices. So can you just throw some light on how we are placed, how prices are placed when compared to Odisha miners? Can we expect
generally slightly more than the Odisha miners always? Because because of the quality difference, and B, also because of the logistical, iron ore market is logistic driven. So an Odisha miner possibly selling in Raipur area of Chhattisgarh doesn't make too much of sense for them. We going to the Raigad area of Chhattisgarh doesn't make sense to us, all because of logistics, right? So it's a driven market. Unless the prices differential are so huge that the logistic differences are actually wiped out. So normally on an average, if you see, we are generally 8 to 10% higher than the Odisha prices. That's the normal thing. But there have been instances where the spread has been either sometimes much lower, but generally it is on the higher side.
Okay. Another thing, sir, if you could throw some light on, there is a fear that Odisha miners would ramp up their productions, but is there enough infrastructure to support the evacuation of the ramped up production?
That is the only constraint we hope that will come into play, because it is very difficult to ramp up the infrastructure for evacuation. It is easier to ramp up the infrastructure for production, but not so for evacuation. And of course, the capacity of consumption within the local Odisha area, which can be amenable to, which is the flexible one, if road, so that is fairly limited. So we are hoping that the constraints of evacuation would bar them to really have too much of an increase in production.
Agreed. And lastly, sir, do we expect to participate in auction next year for buying new mines?
Well, that's a company strategy that we will not be able to discuss in public now. We are debating that. We'll take a call as and when we need to take one. But I would not like to speculate about our stand, whether we should. We are now petitioning all the governments that we are entitled to allotment on reservation basis. There are trade bodies of steel manufacturers, especially the smaller steel manufacturers. They have been petitioning the government as well that NMDC should be allowed a certain amount of mines so that there is a surety of supplies. So there is a convergence of view there. We are petitioning, we are requesting this certain state governments. Let us see how things go.
Okay. Thank you and best of luck.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the floor back to the management for closing comments.
Thank you for the patient hearing. It's been a pleasure talking to all of you. I hope whatever clarity that you were seeking has been communicated. I hope we believe that we'd like to say a few more things for your kind information. Now, we have noted that our operations are at par with the best of the world. You see, our mine head cost is today, the C1 cost of production is around $11.5 for this year. And if you see the big four, whether Rio Tinto or BHP or Vale or FMG, they are all higher than us. At BHP is at around 14.3, Rio Tinto is around 13.3, Vale is 12.5, FMG is 12.4. Further, our EBITDA this year has been 62%, which is equal to higher than Rio Tinto of 61, BHP of 61, and much higher than FMG of 46. Our dividend yield of 5.6 is much more than BHP or FMG. It's slightly lower than Rio Tinto. So on a lot of parameters, if you see, our operations are at par with the big four and at par with the so-called, they must be the best operators as well. So our operations, although the scales has been our 10th, we are the 10th biggest merchant miner in the world. But if you see the operation efficiencies that we have and the overall performance on a global scale, we have done a fairly commendable job. So this is something that I would like to convey to you, that our operations have been otherwise world-class and at par with the best of the world. With that, I'd like to thank you for the patient hearing. Thank you so much.
Thank you very